Hello, everybody. In this session, we are talking about capital. Capital is a broad term that can describe anything that confers value or benefit to its owners, such as a factory and its machinery, intellectual property like patents, or the financial assets of a business or an individual. Business capital may derive from the operations of the business or be raised from debt or equity financing. When budgeting, businesses of all kinds typically focus on three types of capital: working capital, equity capital, and debt capital. A business in the finance industry identifies trading capital as a fourth component. And then we move to the relationship between capital and cash flow. The relationship between capital and cash flow is extremely important for businesses. Cash flow management needs to ensure that the company has working capital ready to meet its financial obligations. Working capital and cash flow are terms that are often used interchangeably. However, while working capital provides a snapshot of your company's finances, cash flow refers to have and how much each the business is able to generate within a given time period. And then, what is the difference between capital and money? The terms capital and money, of course, are certainly related, but they are not interchangeable. As a business owners, it's important to know the difference. Money is cash that you spend, and capital is cash or other asset that you put to work. The money in your wallet isn't a form of capital unless you put it to work earning you more money. People in finance often describe capital as having greater durability than money because it can be continuously reinvested to earn more value. And then we move to capital in economics. From an economic viewpoint, capital is necessary to keep a unit functioning, so it lives on both the short and long-term areas of balance sheet. A unit can be an entire economy, a large corporation, a small business, or even a family. Assets considered capital include sellable securities like factories and equipment and cash equivalents. It's both a measurement of wealth and research people and businesses tap into to increase their wealth. For example, economists tie an individual's net worth to the amount of capital and capital assets they hold. Whether you're a company or individual, how you finance working capital and invest obtained capital are critical to growth. And then we move to the types of capital. People sometimes use the term capital to refer to any asset a company can use to operate and grow, such as human capital or social capital. However, there are several main types of financial capital, including equity, debt, working, fixed, and trading capital. Each type plays a crucial role in how businesses fund their operations and growth. We start from the first, equity capital. Equity capital is the money invested in a business by its owners or shareholders in exchange for ownership stakes. It includes funds raised through selling shares of stock, retained earnings, and private investments. Examples of equity capital sources are initial public offering or IPOs, private security, and venture capital. And then the second, trading capital. Trading capital is the amount of money allocated to buying and selling securities in the financial markets. Companies and individual traders use trading capital to participate in markets like stocks, bonds, and foreign exchange. And then third, debt capital. Debt capital includes borrowed funds that have to be repaid, usually with interest. This includes loans, bonds, and lines of credit. Businesses can get debt capital from bank loans, corporate bonds, and private lenders. Since lenders don't have equity or voting rights, business owners can retain full ownership and control over the business with debt capital. The interest payments may also be tax deductible. And we move to fourth, fixed capital. Fixed capital is the long-term investments in physical assets that businesses use for production and business operations. Fixed capital assets last longer than a year and retain their value over time. Businesses use fixed capital for long-term growth, such as infrastructure and machinery. Some common examples of fixed capital assets are buildings, machinery, equipment, and vehicles. And then, fifth, working capital. Working capital is the money a business has available to pay for its day-to-day operations. It's defined as the difference between a company's current assets and current liabilities. Businesses need working capital to stay liquid, which means they can pay short-term debts and operational expenses. And then, why is capital important? Capital functions a vital role in the modern productive system. We start from the first. Production without capital is not possible. Elaborate tools and sophisticated equipment are required for modern day production. And then second, capital helps in creating employment opportunities. Workers are employed to produce capital goods as well as consumer goods. And then third, it increases the productivity of employees and in turn the economy as a whole. Importance to technology and specializations alongside a growing population has left manufacturers to arrange for more capital and light resources to fulfill to the demands. I think it is enough for this session. Thanks for watching and don't forget give this channel with your like, comment, subscribe and share. Thank you.